Have you ever wondered who is behind the liquidity that allows you to buy and sell currencies instantly? Today we're going to talk about market makers, the key players without whom the market could not exist. You will learn how they work, how their actions affect the market, and, most importantly, how to use this knowledge in your trading. And at the end of the video, I will share simple techniques that will help you make money together with market makers. But before we analyze how market makers influence the market, let's answer the main question: who are they? After all, without understanding their role, it is impossible to understand how Forex works. So, market makers are professional market participants who provide liquidity. Their task is to constantly place buy and sell orders, so that traders can make trades at any time. They can be large banks such as JP Morgan or Citibank, financial institutions, or even special companies that work on exchanges. Their main function is to keep the market stable, but they make money on the spread, the difference between the buying and selling price. For example, if you see that the buy price, bid, for EUR/USD is 1.1000 and the sell price, ask, is 1.1002. These 2 points are the spread, which partially goes to the market maker's pocket. But did you know that market makers can not only make money on the spread, but also influence where the price will go? We will talk about it later. And now let's understand how their business is organized. The spread is the main source of market makers' income, but it is only the tip of the iceberg. One of the key tools they use is high-frequency trading. This is a technology that allows thousands of trades to be made per second. Market makers use powerful computers and complex algorithms to analyze the market and react instantly to changes. For example, if the price of EUR/USD starts to move up, an algorithm can buy the currency in a split second and then sell it slightly higher, capitalizing on minimal price changes. But how does this work in practice? Imagine that a large order to buy euros appears on the market. The market maker's algorithm instantly notices this and starts buying up the euro at a slightly lower price, with the aim of selling it at a higher price. This happens so quickly that an ordinary trader does not even have time to notice such movements. This is why their business is so profitable. Now that we know about the basics of how market makers work, let's go straight to practice and see how they manage the market. It will come as a surprise to many that in most cases, market makers are the ones who draw patterns on the charts to create traps for regular traders. Let's break it down with some real examples. Do you see this classic head and shoulders pattern? For many traders, this is a sell signal. They see the price break the neckline and open trades down en masse. But what happens next? The price does not continue to fall as expected, but reverses upwards. Why? Because it was a trap of market makers. They deliberately drew this pattern to attract traders into the trade, and then turn the market in the opposite direction. Now, let's look at another example, a false breakout. Here's a support level. Traders who see the price falling below this level start opening trades to sell, expecting a further fall. But what happens next? The price turns around and goes up, leaving traders with losses. This is a classic stop hunt organized by market makers. They know where the stop losses are and move the price to activate them. It is also important to know that market makers not only draw patterns and create false breakouts, but they also like to trade before important news. And now you will understand why. News is a great tool for market makers. When unemployment, interest rates, or other economic indicators are released, the market literally boils. Volatility soars, which means that there are many opportunities for manipulation. Imagine the situation. Tomorrow, the report on non-farm payrolls in the U.S., one of the most important economic indicators, is released. The day before, market makers can artificially lower the price, creating a sense of bearish mood in the market. Traders, seeing this movement, start to open short positions, expecting a further drop. But what happens after the news is published? The price suddenly turns around and the market rushes upwards. All stop losses of traders who were betting on the decline are knocked out, and market makers take their money. Another scenario, before the release of interest rate data, market makers can drive the price into a narrow range, creating what is known as a seesaw, when the price goes up and down in a small corridor. Ordinary traders do not understand what is happening. They start putting stops at obvious levels. And then there's sharp movement in the opposite direction, and again the same stop hunters collect liquidity. Do you know what the best part is? Market makers can use not only real news, but also market expectations. Even rumors or expectation of certain data can become a manipulation tool for them. But in that case, how can you protect yourself from market makers' manipulation, and is it even possible? The good news is that, yes, it is possible. Although market makers have more resources and tools to manipulate the market, the retail trader has his own strengths. The key is to know how to use them properly. The first rule is to avoid trading on the news. Remember that at times of high volatility, market makers like to shake the market, knocking out stop losses and creating false movements. The second is not to place stop orders at obvious levels. Market makers know perfectly well where stop losses are located and can artificially pull the price to the necessary mark. The third is to use volume indicators. If the price movement is not confirmed by volumes, it can be a sign of manipulation. For example, if the price rises sharply, but the trading volume remains low, it is most likely a trap. The fourth is not to give in to emotions. Market makers often use psychological traps, forcing traders to make impulsive decisions. For example, when you see a sharp rise in price, you want to jump on the train. But such movements often end with an equally sharp reversal. And finally, learn to analyze the market from the position of big players. Look not only at technical patterns, but also at the price behavior on the chart. But the most important aspect is probably the ability to control your emotions, because market makers know more about them than you do. As you have already realized, market makers skillfully work with the psychology of the market, understanding how most people think. This is what gives them the ability to manipulate price in this way. Imagine you see a strong upward movement on the chart. Your emotions begin to dictate to you. You have to buy quickly or the train will leave. And at that moment, you are no longer a trader, but a victim of your own greed. Market makers know this feeling and they make money on it. They create the illusion of endless growth or deep fall to trap traders. When the crowd buys at the top, the market makers start selling. When everyone sells in a panic, they, on the contrary, buy up assets at a low price. Fear is another powerful tool in the hands of market makers. For example, false breakouts of support levels often create panic among retail traders. Just as the crowd starts to close positions at a loss, the price suddenly reverses. Why? Because the market makers have gathered all the cheap assets and are now ready to move the market in the direction they want. Market makers also know that most traders are focused on popular indicators, such as RSI or MACD. Therefore, they can create situations where the indicators give false signals. For example, overbought on RSI can be artificially created so that traders start selling and market makers start buying. And what to do? The most important thing is to realize that the market often moves against the crowd's expectations. If everyone is confident in growth, there is a high probability that market makers will make a correction. In order to trade with profits, it is not necessary to understand the logic of market makers in depth. There is a convenient solution for this: an expert advisor, MiloBot PRO, which trades independently without your participation. If you are skeptical about trading robots, here's a concrete example. Over the last 4 years, MiloBot PRO has increased its deposit from $34,000 to $272,000, and all this in a fully automatic mode. And most importantly, you can test it yourself. Download the demo version and check how it works on any time frame. See how it performs without risking your capital. To purchase or download the demo version of the MiloBot PRO, go to the MQEL5 website. You will find all the links in the description below this video. You shouldn't blame market makers for your stop losses. Now that you know who they are, how they work, and what methods they use to manipulate the market, you can use this information to your advantage. Instead of being a victim of their manipulations, become one of those traders who understands the logic of the big players and trades with them. Remember that knowledge is power, especially in the financial markets. The better you understand the mechanics of the market, the less you can be confused. If you like this video, don't forget to like it and subscribe to the channel. More useful strategies, breakdowns, and tips to help you become a more successful trader are ahead.